So if there was an elementary school for central bankers, imagine little Tiff Macklem and Jerome Powell. Grade 1, day 1, understanding the power of interest rates. Yes, this is a school for gifted children. But one of the first things they'd learn is that if your goal is to tamp down inflation, the economy's running too hot, everything is getting more expensive, you raise interest rates. Because doing nothing, just letting prices go up and up and up, it's messy. The increases are uneven, some things spike. As a consumer, you don't really know what next week or next month is going to look like, so you stock up on things. Money just doesn't go as far, so people start demanding higher wages. Businesses don't know how to plan. It's a mess. Raising interest rates, though, that's predictable and controlled. Yes, it makes things like mortgages and loans more expensive, but that forces households to cut back on other things. That cools overall demand, which, if people are buying less, eventually helps slow the increase in prices. So why, when we keep seeing headlines like these in Canada and the US, inflation on the rise, why would both the Bank of Canada and the US Federal Reserve be deciding instead to cut interest rates?
Breaking news this hour, the Bank of Canada has just cut its key interest rate by 25 basis points.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point.
We've got a lot of inflationary pressure in the pipeline. That right there might lead you to wonder what we're doing.
Until today, Canada and the US have been managing interest rates a little differently from each other. When pandemic prices shot through the roof, the Bank of Canada's key interest rate rose to an almost quarter-century high, 5%. That's in line with what central banks around the world did. But starting early last year, Tiff Macklem would go on to announce 7 consecutive rate cuts. He could do that because inflation was getting under control. And a textbook way to kickstart a sluggish economy is to lower interest rates and get people to spend more. The US Fed, on the other hand, under Jerome Powell, he's cut rates only 3 times over that same period. And until today, rates had been frozen, relatively high since last December.
He's always been too late, hence his nickname, Too Late. He should have cut interest rates a long time ago.
So yeah, Trump didn't like that.
I think he does a terrible job. He's costing us a lot of money.
We'll touch more on that later, but the difference in approach between the two central banks does illustrate at least one thing, and that is they have other things to at least consider besides just inflation. In Canada's case, when your economy's being hammered by Trump's tariffs, and it's actually contracting.
Statistics Canada data shows the country's GDP slowed by 1.6% in the last quarter.
Then the Bank of Canada has to think a bit outside the inflation box.
So broadly speaking, the mandate of the Bank of Canada is to promote the economic health and welfare for all Canadians. It has to look at all of the economic data coming in, and it sees everything through that lens.
So lowering interest rates gives people more spending power and gets more money to mix around. And it certainly helps that the Bank of Canada isn't that stressed about inflation right now. Yes, it's on an upward trend, but where it's at today, just under 2%, is well within what's considered acceptable. And the US, it actually has a legal obligation to consider not just one thing, but 2 specific things.
The Fed in particular has actually a dual mandate. They have inflation at 1 to 3% range, which Canada does, but they also have another mandate for maximum employment.
It's being pulled in 2 different directions. The labor market clearly has softened over the course of this year. And that's a cause for concern because in the United States, when the labor market goes into recession, it does so in a hurry. So the Fed really doesn't want to be caught 3 steps behind the parade.
And this is something both economies actually are having to contend with right now.
Recently, the data in both Canada and US has pointed towards lower hiring, a lower amount of hiring, higher unemployment.
Across July and August, Canada shed altogether more than 100,000 jobs.
We've got 1.6 million people unemployed right now, with only 33% of them receiving jobless benefits. So we are not recession ready.
The US, its position isn't as bad, but it's not great. With Trump's massive federal layoffs, the federal government alone is down 97,000 positions so far this year. Even manufacturing is down nearly as much. In a world where tariffs raise the input costs of the raw materials they use, retaliatory tariffs put a damper on how much they can sell, and all-around uncertainty puts a chill on how far they can plan. So, the logic goes, if you've got a weak labor market and the economy is showing signs of getting squeezed, then lower interest rates, which makes borrowing money cheaper, which juices the economy and promotes hiring.
They're saying you don't have to spend as much to cover your monthly debt payments. That should free up some capital in your business that would allow you to hire, that would allow you to cover the costs that you've taken on because of the tariffs, the trade war, the uncertainty, or just the slowing of the Canadian economy. It just gives everybody a little bit of cushion.
So most economists seem to agree the latest moves by both central banks make sense. But can I just point out how the pressure on both central banks is immense? Because what both countries also have to contend with is, and let's get back to it now, the Trump factor. When July's less than stellar US job numbers came out, Trump claimed those numbers were rigged.
We're doing so well. I believe the numbers were phony.
He took the unprecedented step of firing the commissioner of the Bureau of Labor Statistics, ignoring that the numbers are compiled and revised with the input of hundreds of researchers.
These numbers were not rigged. This is a supernatural part of how we measure job growth. You got to get these numbers really fast so you can know what to do with them. But as you get them that fast, sometimes you got to revise them to make sure that they were actually accurate.
It's not possible for the commissioner to have that influence. I was never in the room where the data was collected.
But it begins to show you what Trump's frustration can look like when made manifest. And he has been relentless in his insistence that Jerome Powell cut rates. Not just by a little bit, but by a lot. As in about 12 times steeper than the quarter-point cut that was just announced.
I think you have a big cut because I don't think he can help with cutting. It's perfect for cutting.
President Trump actually wants the Fed to move from having its foot lightly on the brake to slamming its foot down on the accelerator in a way that would only normally make sense during a recession. That's not a quarter-point hero there. That's a lot. That's a dramatic difference, and that would lead to dramatically different outcomes.
Now, I'm not at all suggesting that the chair of the Federal Reserve in cutting rates is somehow caving to pressure. There are solid economic reasons for the latest rate cut.
Not only has the data and jobs not been that good, we've seen big downward revisions in the US to the previously announced jobs. So from his perspective, the data is allowing him to ease.
My assessment is that's a perfectly sensible, modest adjustment to make.
But consider the landscape. Two members of the Fed board, which makes the decision about whether to cut interest rates, they dissented back in July from the chair, Jerome Powell, objecting to his preference to keep rates steady. They're Trump appointees, and they wanted a rate cut, which didn't happen at the Fed's last meeting. But this time around, there was even more turbulence. Trump is attempting to fire a Biden appointee, Lisa Cook, a move she's fighting in court. And just a day before the Fed board was scheduled to meet this week, the last-minute confirmation of Stephen Myron, a senior White House official, a member of Trump's own government, who is now one of just 7 members of this board, which is supposed to decide U.S. monetary policy in a completely nonpartisan way.
The yeas are 48, the nays are 47, and the nomination is approved.
He declined to resign as chair of the Council of Economic Advisors. So this is literally unprecedented that a member of the president's administration has been present and voting on interest rate decisions. We haven't had that in the history of the Federal Reserve.
So 3 out of 7 members of the Federal Reserve Board, broadly at odds with the chair of the board. This brings the scale of division within this otherwise generally united, out of the spotlight group, the sheer amount of chaos being injected to a level it hasn't seen in 30, 40 years. So it goes without saying that for all of the legitimate fiscal and economic reasons Jerome Powell might have had to cut interest rates, as he's just done, It may also have been the path of least resistance, a happy coincidence that the economically sensible option happens to line up with what Trump has been demanding. And allow me to state the obvious, that Canada's situation is also complicated by Trump.
There's still a lot of uncertainty about where prices may land because it's unclear where tariffs land. Not only have tariffs been moving up, down, and sideways, we haven't even entered the CUSMA renegotiation.
There's still fiscal spending going on. We've seen the announcement on housing. We know there's going to be more spending in defense. So that is stimulative into the market as well. And these are the considerations that the central bankers have to take into account.
It's always difficult explaining monetary policy because there's never just one cause or driver of change. And for that matter, never just one effect or outcome. Both economies are also dealing with slumping housing markets. And there's a bigger question about whether the real economic bottleneck here is even interest rates at all, because what hard numbers ignore is whether there's enough confidence in the economy to move all the economic sliders in the right direction.
We might be one bad shock away from a recession. That one bad shock might have already happened. We might be fortunate enough to avoid it. For sure, that's a time you don't want your foot on the brake. So that part's easy. The more interesting discussions are not the ones at this meeting, but in the future, which is whether the Fed should tap its foot on the accelerator.
Because we all know from the last 9 months, trade wars can turn on a dime. And while right now, both economies locked in combat may have arrived at the same inflection point, the same decision to cut their key rates, it's very hard to judge how far each central banker will push rates down, whether after this week we might see even deeper cuts.